Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a Loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to do something a little different. We're going to tackle some of the macroeconomic themes that have the potential to sideswipe the Canadian economy and or capital markets. At IceCap, we place a lot of emphasis on managing risk for clients and their portfolios. And in the following video, we're going to go over some of the risks that we are keeping a keen eye on. The first is rising long-term government bond yields. This month marked an ominous milestone for the Japanese bond market. The 30-year Japanese government bond yield hit a 25-year high. Japan has one of the highest government debt to GDP ratios in the world and the second largest bond market in the world. And so this is a big deal. And it played an important role in lifting long-term government bond yields across the rich world. Remember, higher bond yields means lower bond prices and tighter financial conditions. Now, this has been a long time coming. Worries over the Japanese debt market and debt levels have hung over Japan and global markets for decades. But with a growing inability to control government spending, paired with rising inflation that is proving to be much stickier than expected, bond investors are bailing on that market, which is sending yields higher. They want to be compensated for that risk and are demanding a higher return or yield. It's important to note that Japan is not alone in this. Recent news out of the US and the UK is putting a growing shine on the fact that no one, it seems, is able to control government spending. There is no appetite for austerity in Europe, Asia, or North America, and across the world, some government debt burdens are increasingly seen as unsustainable. We know this because investors are selling long-term government bonds, sending yields higher. And we are getting warnings from organizations like the Bank of International Settlements, the BIS, an important resource for central banks, that we've reached the limits of central bank intervention. And I quote, "Fiscal authorities must provide a transparent and credible path to safeguard fiscal solvency, ideally underpinned by stronger fiscal frameworks. Central banks cannot be the only game in town." So without a credible fiscal path or budget surpluses every now and again, we face a risk of rising inflation and a sharp exchange rate depreciation, a potential vicious circle that left unchecked can lead to sovereign debt defaults or worse. Canada, of course, is not immune. According to the Desjardins economists, the federal budget deficit is expected to get much worse. There isn't even going to be a budget in 2025, which besides being completely outrageous from a democratic perspective, it exposes that the guardrails are well and truly off. The numbers are likely so bad that the federal government is hiding. Why else would they not show us the books? The truth is the federal government is unable to rein in spending as revenues fall with slower economic growth. And to be clear, uncontrolled spending is not benign. There is no free lunch, despite the desperate attempts of some politicians and those in the media to convince us otherwise. Any kind of deficit spending means adding to your debt burden, and that debt has to be paid back, eventually. And in the meantime, it must be serviced. The problem Canada faces is that debt levels are high, and much of that debt was issued over the past few years, and it's coming due. This means that debt charges, or interest payments, will continue to rise because that debt will be refinanced at much higher bond yields, in part because of Japan. The second risk is of falling oil prices. Despite the protestations of many people in the media and much of our political class, Canada is a petrostate and the dollar remains a petrocurrency. The following chart is that of oil prices and a basket of major European currencies. It's a simplified illustration, but it proves an important point. The Loonie moves lockstep with crude oil prices. Crude oil is vital to the Canadian economy, and this is not about GDP or employment. It's about the current account or trade balance. Canada sells oil to pay for imported goods. And in simple terms, lower oil prices at the margin mean less money coming in, and this includes taxes and royalties. We remain positive on oil prices over the long term. Crude oil demand is here to stay. But over the near term, there's a risk that increases in production from OPEC might send prices down. OPEC, or the Organization of Petroleum Exporting Countries, is not as important as it once was, but it still controls a huge chunk of the market. And if they turn on the taps, we might see lower oil prices and a lower Loonie in the near term, as well as less hard currency inflows. The next risk is of weaker global growth. We think the trend started well before the tariff fiasco, but obviously increasing trade protectionism has not helped, nor will it. The chart I'm highlighting is of South Korean exports, which is a decent proxy for global growth because South Korea is an export-driven economy and focused on key goods like semiconductors, cars, and reflects global demand and supply chain dynamics. Its trade data is also closely tied to major economies and released early, so provides a timely indicator of global economic trends. The weakness that we're seeing in South Korea is also confirmed by the manufacturing sentiment, which continues to decline. The final risk is that of a sell-off in global risk assets, i.e. stocks, which incorporates and reflects much of what we've talked about. Rising long-term bond yields, tighter financial conditions, slower economic activity and trade, weaker sentiment, and we can see with the blue line on the chart, a contraction in earnings expectations, which again reflect a darkening view of future corporate profitability. I bring this up because the story we are often sold is one of diversification. But in a meaningful sell-off, all correlations go to one. That's statistics jargon for there is nowhere to hide in equities. But thankfully, there are ways to take advantage of these eventualities. And at IceCap, we see an incredible opportunity ahead of us. All right, that's a wrap on this week's episode. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.